Hi, I'm Doug Goldstein with Profile Investment Services here in Jerusalem. If you have any questions about today's discussion, please feel free to be in touch with me. My email address is doug@profile-financial.com. Today we're going to talk about the topic, don't leave tax loss harvesting to the end of the year. Many investors optimize their portfolio to minimize capital gains tax. One popular strategy is to do tax loss harvesting. What is tax loss harvesting? Tax loss harvesting is the practice of selling a position at a loss and matching the loss against a gain of a different stock that you sold. By offsetting losses against gains, capital growth taxes are only paid on the net profits. While this may be a tempting tax-saving strategies, there are three reasons to avoid the end-of-the-year market-selling frenzy. First one is the wash sale. If you sell a security and buy it back, or buy back a substantially similar security, within 30 days of selling it, it's called a wash sale. Wash sales negate any tax loss selling strategies, and your attempt to harvest a tax loss would be disallowed by the IRS. Don't be the short-sighted individual who sells at a loss and then the next day when the stock begins creeping up, wants a piece of the action and buys it again. This scenario nullifies any potential benefit of tax loss harvesting and causes further losses by increasing commission costs. Next thing, impending tax law changes. Selling a position at a loss allows you to offset taxes on potential capital gains in a given tax year. However, since the tax codes are constantly changing, you can't know what your future tax situation will be. If the government raises capital gains tax next year, you may have been better off saving your tax loss harvesting to use in a year with a higher capital gains tax. Also, for American taxpayers, capital gains tax is different on long and short-term investments. So the time you originally purchased the security may affect its potential taxes. And lastly, market uncertainty. The uncertainty of knowing when a declining position may reverse itself adds further ambiguity to tax loss selling. An unrealized loss might actually turn around, but if you sell just to capture the loss, you can't benefit from the recovery. While tax considerations should come into play when making buy and sell decisions, tax considerations should never be the only reason behind a transaction. Always ask first. If you are considering tax loss harvesting, consult both your tax and financial advisors. You should always ask a tax professional before making any decisions that can affect your taxes. Call my office at 02-624-2788 if you have any questions about your investment portfolio. Please, before doing any investing, make sure you read the complete disclosure at www.profile-financial.com/disclosure. My name is Doug Goldstein. You can be in touch with me at doug@profile-financial.com.